So in today's video, we are going to discuss the Modified Endowment Contract, also known as the MEC. So when it comes to a whole life insurance policy that is set up for maximum cash value, if that's what you're interested in, you've probably heard of this term. If you're in the business, you've definitely heard of this term. Preventing a modified endowment contract on a whole life insurance policy is very important if you have intentions to use the cash value. Whether you want to take loans against the policy, you want to take income down the road. If your policy becomes classified as this modified endowment contract, you're likely going to have to deal with tax down the road. Almost always income tax as well on any of the gains. So in this video, we're going to go through thoroughly what a modified endowment contract is. We're going to compare the tax benefits with a modified endowment contract and a non-modified endowment contract life insurance policy. We'll go through the MEC limit, how to set your MEC limit, what to do if your policy ever becomes classified as a MEC, what happens if you accidentally go over the MEC limit. I'll answer that one very quickly. It's very easy to reverse as long as it is done so within 30 days of triggering a MEC. And the insurance company notifies you and your agent. Very, very simple. We've had it happen a number of times, of which never has a policy actually permanently become a MEC when we were notified, and we were never not notified either. So let's have some fun with this one. When it comes to a whole life insurance policy, why people are interested in it, I'm going to set the foundation before we get into the MEC treatment here, is the core benefits here we often refer to as the cash value. It is a safe, liquid, and tax-free area to position money. Safe, meaning if it's properly set up with one of the top companies, specifically the 4 major mutual companies. We've seen this, we've got historical data to validate it. It'll typically produce a net internal rate of return between 3 to 5%. Liquid, you can access the money in a cash value life insurance policy anytime you want. And a unique feature to a life insurance policy with respect to how loans work, once a dollar passes through that cash value, if you just let it sit and grow and earn, call it 4% in between the 3 to 5, or if you decide to take a loan against it. Let's say you have $100,000 in cash value, and you take a loan of $50,000, half of your equity. If you take a $50,000 loan, you'll still earn that 4% on the full 100 as if you never touched it in the first place. Interesting, isn't it? A lot of real estate investors are interested in that, and often they'll either borrow directly from their policy or utilize a cash value collateral loan. We've got a lot of other content on that. And then tax-free. That's always been a huge point of attraction to cash value life insurance. If we do it properly, it's tax-free. And then, of course, the death benefit is paid out 100% income tax-free. This is very popular when it comes to legacy planning and also just life insurance protection. What I'll add as we get into the MEC treatment of life insurance policies is the death benefit is always paid out income tax-free, regardless of your policy being a MEC or not. Let's compare some of the main bullet points here with a non-MEC policy and a MEC policy, specifically with respect to the cash value buildup and how taxes work. So with the non-MEC, on the topic of cash value, the growth is technically tax deferred. It is not automatically a tax-free asset. Your cash value per the IRS does grow tax deferred. However, you can access your money anytime you want, completely tax-free, if it is done so properly. I emphasize that word if for a reason, and the specific reason why I do that is cash value life insurance is always marketed tax-free, 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 and there's not enough awareness on this subject in my opinion. So one of the ifs that can trigger a taxable event is a modified endowment contract. There are other cases as well, which we've got some content on that. Just search the word whole life taxes in our YouTube channel, and a couple of videos will pop up that provide some examples. But how do I take the money out tax-free, specifically with a non-MEC here? Well, there are 2 transactions which allow me to actually pull money from the cash value in my life insurance policy. The first one is a policy withdrawal. If you have a whole life insurance policy, you can always withdraw up to your cost basis. Your cost basis is the total amount of money you have paid into the policy. So if I've paid in $100,000 and I have a cash value of $300,000, my cost basis would be my $100,000 that I've paid into the policy. So I can always withdraw up to my cost basis. Anything beyond that will be taxed. It'll also be taxed as ordinary income. Loans. can be taken completely tax-free. Now, with that said, because we don't want to put the gotcha moment in there, what can trigger a taxable event here is if I surrender the policy. If I say, hey, I'm going to cash this puppy out, I'm no longer interested in this policy, I don't have a need for it, I'm just better served with my money elsewhere, that's your personal feeling. Well, in that particular case, you would be liable to pay ordinary income tax on the gains. So, for example, if you, again, let's use this example, have a cost basis of $100,000, that's the total dollar amount you've paid in. Your cash value has grown to $300K. That means you have a gain of $200,000. If you cashed that policy out and said, send me the check for $300,000, which they would do, $200,000 would be taxed as ordinary income, added to whatever other income you earn for the year as well. So I do want to be aware of that. Another example is if a policy lapses. If a policy lapses and I've taken more money than what I've paid in, kind of like a surrender issue, I'll be liable to pay income tax on the gains. If there's a large loan balance on it, that can actually make the pain even worse, the tax bill even larger. Our other content really goes into detail on that, but those are cases that can result in taxable events on non-MEC policies. They don't happen that often, but when they do is when awareness does not exist. The death benefit, like we mentioned earlier, paid out income tax-free, and that was all around the subject or the topic of a non-MEC policy. So on the modified endowment contract, using the example on the left as a foundation, on the cash value, the growth is still tax-deferred, regardless of your policy being a MEC, a non-MEC, or a modified endowment contract. That cash value buildup over time is tax-deferred. With a MEC, if you never touch that cash value, you don't have to worry about the taxes. Now, here's where you do have to worry about it. If you ever decide to access the cash value, you're going to be taxed on the gains, and it's going to occur on a last in, first out basis. So let's explain that a little bit. Take the same example. Let's assume that you've paid in $100,000. Your cash value has built up to $300,000 over time. You have gains of $200,000. If you said, okay, I'd like to take income from my policy, and it's a MEC, the gains of $200,000 will be taxed first. So you've got $300,000 here. You say, hey, I want to pull out $100K to purchase a piece of property, or I just want to pull that much out, that amount of money out as income. You would be taxed on that. Even though it's your cost basis, you're taxed on last in, first out basis. So the gains will be taxed first, and then once you've pulled out $200K total, then the last $100,000 in there would not be taxed as ordinary income. Because with a life insurance policy, all of the payments you make are made with after-tax dollars, meaning we cannot deduct it like we could with a 401k. With that said, you can put a life insurance policy in a qualified plan, which will permit you to deduct payments or the premium payments within the qualified plan. However, most people don't do that as it ruins it strips a policy a lot of the tax benefits. So a lot of info there. Next, any distributions you take from that MEC policy, from a modified endowment contract, are taxed as ordinary income. And then in addition to that, if you touch it prior to age 59 and a half, there's a 10% penalty tax. That 10% penalty tax will almost always exist with the exception of two reasons. One is if you're over the age of 59 and a half. Two, if you're disabled. If you're under the age of 59 and a half and you have a disability, then you could be exempt from that 10% penalty tax there. So let's look at some more info here. We've got quite a bit more to cover. So the last point we touched on there was any distributions are going to be taxed as ordinary income. So my question would be this: what is classified as a distribution aside from just what are commonly thought to be distributions with life insurance policies being withdrawals and loans? Because this is important and it's not often covered. With a modified endowment contract, any unpaid loan interest is going to be taxed as ordinary income each year. So for example, if you have a $100,000 loan at 5%, that will come out to what? $5,000 in loan interest. If you did not pay that $5,000 in loan interest for the year, what's going to happen is you're going to get a 1099 for $5,000 that'll be added to your ordinary income for the year. So unpaid loan interest is taxed as ordinary income each year. If you pay it, you don't have to worry about it. Automatic premium loans, the APL. This is a case where your base premium is due, but you don't pay it. You do not pay any money out of pocket to cover that base premium. You elect to have the policy take an internal loan to pay the premium for you. With a modified endowment contract, that premium will be taxable for the year. So for example, if you have a $10,000 base premium, the policy borrows in order to pay the $10,000 premium, you're going to get a 1099 for how much? The base premium of $10K. And then the next year, any unpaid loan interest, if you allow the policy to take an automatic premium loan to pay the loan interest the next year. So again, important to be aware of this stuff. This is where this stuff can happen and it's like, oh, I didn't know that. But then the client's like, you should have known, you're the professional. So we want to make sure we're aware of that. Collateral assignment. A lot of people are not aware of this. If a collateral assignment is on a life insurance policy, taxes will be due. Now, this almost never happens because banks won't take on MEC policies, and insurance companies often have a lot of measures in place to prevent a MEC from occurring on a life insurance policy that has a collateral assignment on it. It's very messy, so there's a lot of measures in place to prevent it from occurring. But it can result in a taxable event. So how do I prevent a MEC? That's the big question. Well, this is the fun part. Did you know that every life insurance policy has a MEC limit? It's also referred to as the 7-pay premium test. And the fun part is that you, the policyholder, along with your agent designing the policy, can set your MEC limit wherever you want. When we talk about policy design, what I often like to ask, the main question I like to ask is, how much do you want the ability to pay into a policy on any given year? If someone says, I want the ability, if things go very well, to pay in $50,000 on any given year, 50 grand. Okay, so what we would do is design that policy with a $50,000 MEC limit. If they want to pay in for a long period of time, we'll overinflate it a little bit, build in a little bit of extra space, but we'll set that MEC limit at a minimum of the total desired payment. So if you want the ability to pay 50 grand per year, we'll have a minimum of a $50,000 MEC limit. And we can set that wherever we want. Now, where the term 7-pay comes from, the 7-pay premium test, really has to do initially with the first 7 years of a life insurance policy. What I like to refer to this as is where the vice grips are very tight on life insurance policies from the IRS. Meaning if I have a policy with that $50,000 MEC limit, I cannot exceed it. The IRS looks at it very closely. If I exceed that limit, my policy is going to become classified as a modified endowment contract. Then I have to deal with all the taxation. If I ever want to borrow against that life insurance policy and my policy is a MEC, I've got to deal with income tax on the gains. Not fun. So payments cannot exceed the MEC limit. However, here's something to be aware of. It is a cumulative limit. And what I like to refer to as rollover space exists. So you remember those old cell phone plans or those commercials more so that I remember? Where you can buy minutes for each month. But if I buy 200 minutes for the month of January and I only use 100 minutes, the other 100 minutes that I did not use will roll over to the next month, February. So then I can talk on the phone more. Those plans don't really exist. Everything's unlimited nowadays. But I remember those commercials. A good illustration because obviously, because I remember it. So how this works specifically is if you have a policy with a $10,000 MEC limit, let's use a simple number here. That's your MEC limit. First year, you pay in $10,000. Your MEC limit was $10,000. So you funded up to the brim, no unused MEC space, zero rollover MEC dollars. We'll call them that. Year 2, you decide to pay in $5,000. Now your MEC limit was $10,000, but you only paid in $5,000. So that means the additional $5,000 of unused MEC space you didn't pay it in, that's going to roll over to the next year. So for example, year 3 rolls around, Your MEC limit is $10,000 plus the unused $5,000 from the prior year. So if you wanted to, you could technically pay in $15,000 that year. But in this example, let's assume you only pay in $5,000 again. Your limit was $10,000 plus the unused space of $5,000. So what happens, you only paid in $5,000, another $5,000 rolls over. Year 4, we do the same thing. Here we go, year 5 comes around. The total amount of money you can pay in, your MEC limit resets at $10,000 plus the unused space from all prior years, which is another $15,000. So you can technically make a total payment of $25,000 for the year, which is what we do just here. An easier way to calculate this, because this can be confusing when you're looking at it year to year, is to say if my MEC limit is 10K per year over 5 years, that's a total of what? $50,000. So what I like to look at here is during the first 4 years, what did I pay in? 10, 15, 20, 25. Okay, year 5, I've got room for a total of 25K. Just another way to do the math, doesn't really matter as long as it's correct. So I could pay in another $25,000 and make a big catch-up payment. What I will add here is the design of that policy and the company selection is very important because not all companies will allow this. Some will, but they require medical underwriting, and some don't. I've got to have the appropriate term riders attached. The company has to be comfortable with me exceeding the annual PUA limits, which are often 10x with the major mutuals. You often can exceed it when I'm making big catch-up payments. We've done it a number of times with a number of companies, so it is possible. Let's look at an actual example on this. So this will be really interesting here. What I want to look at is first we've got a policy here with $100K per year going in for 7 years. So I'm going to fund right up to the 7 pay in this example. We'll get into what happens beyond the next 7 years, but I want to stop in 7 years in this example. Here's my total cash value. This is all based on the new 7702 limits as well. So here we go, total cash value. How's this look? Breaking even between years 3 and 4. Death benefit, just over 1.7 million. What I want to be aware of here, here's the big thing. This is on a 40-year-old male, MEC limit, $100,000, 101 to be precise. So this individual wants the ability to pay in $100K per year, and he does this for 7 years. Max funds it year over year, and here we go. Okay, so everything looks good, but what if this is his plan and he doesn't pay this in? This happens to a lot of people where often they plan to max fund it each year. Life happens, maybe they're a real estate investor, they sell a piece of property, they say, hey, I can make up for lost time. What's the maximum amount of money I can pay into the policy? So here's the exact same policy. You can tell by the first and second year. In fact, why don't we do that first? Year 1, 86 and change. Year 2, 189.07. There's your initial death benefit, 1.727. Here is your MEC limit, just over 100K. So going back up, what do you notice on the annual outlay columns here? Which is interesting. Annual outlay, 100K for 2 years. And I've got 20K per year. And then I make a big catch-up payment of $420,000. No MEC occurs. So year 1, funded up to the brim. Year 2, funded up to the brim, up to the MEC limit. Year 3, I pay in $20,000, but I could have paid in how much? A total of $100K. So there's $80,000 that I did not pay in, but I could have. That unused MEC space, the $80,000, will roll over to the next year, and then I can make a catch-up payment. And that is continuous. Now, let's look at a side-by-side comparison here, because this will make things much easier. And I love putting all this stuff in Excel side by side, because what a lot of people like to see here is the opportunity cost. So here's an example, or these are the 2 illustrations we just looked at. We put it right on Excel. We always do. There we go. What do you notice? On the left, annual outlay, 100K per year. Cash value in the first year, $86,390. breaking even between years 4 and 5, which means it's designed for maximum cash value. A lot of investors and business owners love these type of designs because the opportunity cost, that money is there for them. They can actually use it. There's the death benefit. There's your MEC limit. So here we just fund right up to the brim, total of $700,000 in, nothing after year 7. No unused space because we max fund it year in and year out. Maximum efficiency. Versus option 2, identical policy here. Here's where it gets fun. Years 1 and 2, $100,000. What do you notice with the cash value and death benefit in both of these examples, years 1 and 2? They are exactly the same. Now, beginning year 3 is where things get fun. Year 3, $20,000 go in. There's your cash value growth. So you pay in 20, you get it back plus another $6,000. So it is compounding quite nicely at this point in time. MEC limit, year 3 was $100,000. You paid in 20, which means $80,000 of unused MEC space exists. So we've got the question on the far right in purple, how much money can I add to my policy? That's the question people often ask when I'm speaking with someone that has had a policy for a number of years. What's the total dollar amount I can add? I was just speaking with an individual who has been working with him. I've been working with him for a number of years. He said, hey, I didn't max fund it last year and I didn't quite hit the limit the prior year. What's the max I could pay in? Well, we track that. The insurance companies track it too, so it makes it easy for us. But in this example, what do we notice? So there's the question many people have. Because if you can add to an existing policy without triggering a MEC, instead of opening a new policy from a pure monetary standpoint, from a dollar standpoint, that is in your best interest. If you say, hey, I got to start out a new policy to put more money into a life insurance contract, what happens? You got to go through the early years again. Whereas if you can take advantage of this MEC limit and MEC rollover space, that can really work in your best interest. It's fun when you start really planning with these policies, isn't it? So here we go. 4 straight years of paying in just 20. And this could vary each year, depending on the company and flexibility. But then year 7, what happens? I make a $420,000 catch-up payment. Where I came up with the number 420 in this example is that gets my total payments to $700,000. And why I did this, because so many people have questions on this. Over the years, I've gotten this question time and time again, is what is the opportunity cost on that? Because option A, in the perfect world scenario, I max fund it each year. By year 7, I've paid in 7, I've got 752. In this example, B, I've paid in 7, I've got 712. So I still have more than what I paid in, but it's about, what, $40,000 less. And that's just time value of money. 4 years here, I was not max funding it. Whereas over here, I'm getting more money in, so it's going to start compounding sooner than later. But over here, there we go. Each year, he sees how much he can add. Doesn't have to make a max catch-up payment, but he does in this example. And then after that, if he wants to keep paying, I ran a couple examples here. There we go. That was an example where he elects to continue to pay just $20,000 through age 50, and you can fund forever. It can be a higher amount, lower amount. The initial design is important there because when you make a big catch-up payment like that, that will have an impact on the MEC limit long-term. So we do like to look at that kind of stuff just to make sure we're optimizing things appropriately, but also planning appropriately as well. So a lot of info here. Let's continue on. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.